Most beginners treat the stock market like a casino. Stock goes red, they panic. Goes green, they get greedy. That's exactly how people end up losing money. But if you think investing is gambling, you've got it backwards. In part 1, we talked about why just saving your money isn't enough. In part 2, we found the money you didn't even know you were losing. Now, in part 3, let's fix the biggest mistake most people make: letting that money just sit there instead of putting it to work. Here's a way to think about it. Imagine every dollar you earn is a soldier. Keep them in a savings account, and they're just standing around in the barracks doing nothing. But when you invest, you're sending them out to actually build something, trade, grow. Compound interest is just your army coming back bigger every year. Give it enough time, and that army grows on its own. This isn't about picking the right stock at the right moment. It's about time in the market. So where do you actually start? You don't need to find the next big stock. You don't need to spend your evenings staring at charts. For most beginners, the answer is pretty simple: an ETF. Think of it as a basket holding small pieces of hundreds of companies at once. If one of them tanks, it barely dents your basket. The rest keeps growing. It's honestly one of the safest, most proven ways to build wealth over time. So we've gone from saving to cutting out the convenience tax to now understanding how to actually put your money to work. But there's one trap left: waiting for the perfect time to start. In the next video, I'll show you why that waiting